So today I want to look at interest rates and exchange rates and how these will affect a business that operates in a global environment. For your purposes, this fits in with Achievement Standard 3.3, Topic 5, which is poor investment decisions. It also follows on from when we did the investment appraisal topic in Achievement Standard 3.1. Okay, so first, interest rates. Interest rates influence something called the cost of borrowing for a business. So what is the cost of borrowing? Well, when a business takes out a loan from a bank or another financial institution, it must pay back both the amount that it borrowed and interest. The interest rate influences the interest part of this payment. For example, say a business takes out a loan of $100,000 from a bank, where the interest rate is 3%. We can calculate that 3% of $100,000 equals $3,000. But if the interest rate were 6%, then the amount in this example would be $6,000 for interest. The cost of borrowing has doubled in this case. It may not seem like much in this example, but try to keep in mind that for a global business, we're often talking about millions or billions of dollars rather than hundreds of thousands. In periods of high interest rates, businesses are unlikely to expand, buy new equipment, or hire new employees because of this higher cost of borrowing. Alright, so exchange rates are the second rate I want to look at, and they have more complex effects than interest rates do. Students often find exchange rates far more difficult to understand. For an exporter, they affect how price competitive they are. That is how their prices compare with other businesses' prices. For multinational corporations, they affect the net cash flow received from an investment when it's converted back into New Zealand dollars. So let's start with exporters first. If the New Zealand dollar increases or appreciates, then the value of New Zealand money has gone up relative to other countries' money. We can buy more foreign currency with each of our dollars, but it also means that foreigners can buy less of our New Zealand dollars with each unit of their currency. So because they cannot buy as much of our currency, and our exporters want to be paid in New Zealand dollars, this makes exporters' products relatively more expensive to overseas buyers. More expensive products makes them less price competitive, which means fewer sales. This lowers the net cash flow and income from any investment into exporting. A depreciation or a decrease in the value of the New Zealand dollar would have the opposite effect, making exporters more price competitive. For a multinational corporation, an appreciation in the exchange rate means that when profit is sent from a foreign country back to New Zealand and converted back into New Zealand dollars, it's worth less than it would have been if the New Zealand dollar was weaker. Conversely, a depreciation in the value of the New Zealand dollar means profits coming back to New Zealand and converted into New Zealand dollars would be worth relatively more. Overall, an appreciation is bad for New Zealand businesses competing in the global environment, as it will lower the net cash flows from any prospective investment. And a depreciation in our dollar, on the other hand, will increase these net cash flows. Alright, so to conclude, interest rates will affect the cost of borrowing for a business. A higher interest rate will increase the cost of borrowing and result in lower cash flows from investments, and vice versa. Exchange rates will affect cash flows through the price competitiveness of a business for exporters and relative changes in the value of profits for multinational corporations. Overall, an appreciation in the New Zealand dollar will result in net cash flows decreasing, while a depreciation will increase those net cash flows. So that's it for this video. I'm Mr. Black, and this was how interest rates and exchange rates impact on a global business.